Okay. Good morning, everyone, and thank you for being with us for Wiser Technology third quarter 2025 earnings call. My name is Lubu Yankov, Wiser Investor Relations, and I will be your host today. Joining us on the call are Kosta Jordanov, Wiser CEO, and Kliment Nachkov, our CFO. On today's agenda, Kosta will provide a brief introduction to Wiser and a company business overview, while Kliment will walk us through the financial results for the quarter. Today's call will conclude with closing remarks and a Q&A session. You're welcome to submit your questions in English via the Q&A feature in Google Meet, raise your hand to ask directly, or post your questions in the YouTube live stream chat, where we're also broadcasting today's call. With that, let me now hand it over to Kosta to start.
Thank you, Lubu. Hello, everyone, and good morning. Thank you for joining us today. My name is Kosta Jordanov, and I am co-founder and CEO of Wiser. I will start with a brief introduction of the company for those of you who join us for the very first time, and then we'll provide a quick overview before handing it over to Klimo for a deeper dive into the Q3 numbers. Wiser is an IT services and consulting company with over 2 decades of experience building systems for some of the most important organizations in the world, powering cars, banks, defense systems, technology companies, telecom networks, serving millions of users through the services and the products that we built. Today, a lot of our work is related to applying that same discipline to help enterprises unlock the power of AI as the next evolution of technology and software engineering. At Wiser, we provide a full end-to-end service, software engineering service to our clients, starting with defining the strategy to supporting and scaling systems that run millions of users. Our mission is to engineer software that matters, to build software that has impact, that is being used by some of the largest and most influential organizations in the world, that is being used by millions of users, that creates a future that is wiser, more resilient, and thriving. We serve customers in 5 industry verticals. Those are automotive, aerospace and defense, telecom and media, information technology, and financial services. All of those are industries and clients that where precision is a must, clients that require very high level of engineering, very high level of reliability, very high level of quality of the systems that are being developed. Since this is the last month of the year, it's probably a good time to zoom out a little bit and before we jump into the Q3 numbers, discuss a little bit the bigger trajectory for Wiser. And we embarked on a plan back in 2023 when we committed and communicated a strategic roadmap consisting of 3 phases. Phase 1, growth, with the objective to reach 25 million in annual revenue. Phase 2, efficiency, with the objective to reach 10 to 15% EBITDA, and then scaling globally from there. If we look at the journey so far, in the period 23-25, we managed as a team to deliver for what I would call for a service company a hyper growth. We will end up this year with over 39 million euros in revenue, which essentially we took the revenues from 2.6 billion in 2022 to 39 million in 2025, which is 15 times growth in 3 years. And we are now mid this year, we started essentially moving to shifting focus towards efficiency. This happened a few quarters later than expected, but we used the opportunity to continue to grow. We saw the opportunities out there, and we significantly outperformed on the original revenue target. Since mid this year, we are heavily shifting focus towards efficiency, as we feel this is a necessary prerequisite for us to be able to scale globally, be it further more aggressive M&A, be it more listing on a foreign stock exchange. And this year, 2025, kind of overlaps the growth phase because we continue to grow very, very fast, and we'll share some numbers. It overlaps the efficiency phase since we already starting with H2, started essentially with Q3, started a number of initiatives to shift focus towards efficiency. And it also overlaps with a lot of activities following the active M&A last year. So all of those post-M&A integration activities that are by themselves a prerequisite for achieving efficiency. And if we zoom into 25 and 26 for a second, and essentially split phase two into two sub-phases. One is kind of the integration, which was the big focus of this year. We actually didn't do any M&A this year on purpose. Focus was to finalize the integration of the companies and to build a strong foundation on which we could continue to grow and develop sustainable, scalable business. We achieved, if we look at the organic growth, so isolating for the M&A impact, the M&A from last year, we delivered organic growth of 18%, which is actually pretty amazing if you compare this to the industry benchmarks. It is a year where most of our peers don't see this kind of strong double-digit growth. And mind you, we did this during a very heavy process of integration of multiple companies. And in the second half of the year, starting to also shift focus more and more towards margin expansion. One of the big themes for us this year was unification of team, brand, processes. Not completed, but we made a very solid progress this year, and we are kind of 2/3 down the road. Still some work remaining. We did a lot in terms of sales expansion, with people, with new channels, new partners, with presence now also in Germany and UAE, with companies there. We took a completely new go-to-market approach. We completely restructured our go-to-market team to be much more focused on specific segments that we serve in the market, the industries that you saw, and to be more distributed across several business units. Each of them are kind of serving very niche specific verticals with very, very deep, which gives them the opportunity to build a very deep knowledge in the industries and clients that they serve. We won this year multiple new accounts, including major accounts. We won Ottobock, which was one of the biggest IPOs in Germany this year. We won Mercedes now with direct contract. We won the European Space Agency. We won the DOR, which is the German Space Agency. We won Qiddiya, which is the biggest fun park in the Middle East, and actually many others. So from that perspective, the sales team did an amazing job. Again, in a year that with some industry headwinds and with the complexities of our own complexities of integration and post M&A. Another big focus this year was deployment of the proper systems, as we speak about kind of having the right foundation to grow. This also includes having the right systems to operate efficiently. Starting January, we are moving to an ERP system. So as we speak, there's a very active ongoing process of implementing the ERP, Microsoft Dynamics. We also rolled out the first modules of one of the top human capital management systems in the world, which is SAP SuccessFactors, and we'll continue to roll out the rest of the system throughout the next 2 quarters. And this is very tightly related to efficiency improvements that we are pushing for. We also did a lot of legal restructuring to simplify the structure, starting with multiple companies where we ended up after the M&A spree last 2 years. This year was also focused to simplify the legal structure, and also simplify the management of that structure. And last but not least, we also did a number of investments in increasing our AI capabilities, including in our own platform that is now actually a very significant chunk of our new projects and pipeline is tightly related to this platform, AI Factory. And this was also an investment that we did this year. It's not capitalized, so it went through the P&L completely. So if we look into what's our plan for 26, it's to start pushing more really for that margin expansion, even if this means sacrificing some growth if needed. This means, if needed, dropping some low margin projects, slowing down some investments in growth, meaning keep them at the current level, because this year we actually increased them a lot. So we can slow down a little bit with the growth there. This means we are actively working with a partner to open a delivery center in a lower cost destination. This means changing the team focus, KPIs and incentives, which we already did beginning of Q3. It's about continuing to maintain high engineering utilization through now unified capacity management. What I mean by that is that previously, the individual companies that were kind of somewhat individual within the Wiser family, there was no central capacity management. Now there is, and actually starting October, we see very significant improvements in the utilization of the team. Also, of course, a result of the growing revenues. But also it's about how we manage the talent that we have, and we made big strides this year, and we plan to continue to maintain a high level of utilization. We started this year with like 65-ish% in January. October, we are close to 80. So significant improvements, mostly in the last, mostly within Q3, actually. And then we also plan to continue to optimize the indirect costs to further simplification of the business structure. We'll likely, during this focus on margin expansion, we'll likely also do one or two more M&A transactions. We feel we are ready now after this year and after all the effort that we put into building the systems, the brand, the unified processes. We feel we are ready again to assimilate more companies, more businesses, more projects. So we are actively restarting the M&A process and looking to do one or two transactions in 2026. Two external risks to highlight specifically for the margin expansion targets for next year. One is potential further depreciation of the US dollar. And the second one is, as you all know, there's active discussion regarding another hike in the Social Security burden. We're projecting this in the budget, and we hope that, we'll see how things will develop. In a nutshell, 25, we made a transition from fragmented structure with multiple brands, separate systems, processes, and market identities to a now unified global platform that is a single brand, much more powerful brand that could deliver enterprise-grade solutions with efficiency and scale. Again, we're not fully there yet, but we're 70% down the road, and we feel within the next 2 quarters, we will finalize this foundation that we're talking about. Some of the elements of that were the legal restructuring, increasing the global footprint. So we opened up companies and offices in Frankfurt and in Abu Dhabi. This unification also means unified systems of how we work and how we manage the business. Probably the best way to illustrate that is with a chart of how we started 2025 in terms of group structure and how what's the current structure today. As you can see, many of the companies are not existing anymore because they were merged into Wiser Technology Solutions, our key entity. We have two new entities, the ones in Germany and in the UAE. We have rebranding for most of the businesses. And you would see three businesses that are in lighter colors. They will be also merged into Wiser Technology Solutions within 26, Digital Lights within the first half, and Wiser Technology Consulting till the end of the year. So this will be another, and kind of at that stage, the final step of simplifying the organizational structure. And one more step, actually, we will move Wiser Technology Serbia to also be a subsidiary of Wiser Technology Solutions, so that we have a structure where Wiser Technology Solutions is the operational unit, and all of the regional country businesses are fully owned by it. One important note also is that we now own 100% of all of our subsidiaries, which also simplifies both management and gives us more flexibility to finalize the restructuring. In summary, we do see strong market momentum for Wiser. We saw some strategic wins in terms of new customers this year. We feel that the current Wiser brand and positioning allows us to unlock enterprise opportunities and to continue to execute on our vision and our path to a place where we could start thinking for true global expansion, first on European level. And with that, I would like to hand it over to Klimo for the financial part of the presentation.
Thank you,
Thank you.
Kostas. And thank you all for being with us today. Now, in Q3 of this year, we recorded a record 10.2 million in revenue. This represents about 39% growth for the quarter year-over-year. And on annualized basis, this is more than 40 million euro. We have for the quarter a very slightly positive EBITDA, and this is achieved during a period of restructuring and significant growth. It's also important to note that we are operating in a complex environment. We have the negative effect of the US dollar depreciation, which affected our margins, EBITDA margin, by approximately 4% in the beginning of the year, and it continues to do so in Q3. And this year, we also absorbed successfully the increase of the tax and social security burden in Bulgaria, which is our major base and where most of our employees are located. This is a representation of the results for Q3 in the last 6 years. It's obvious that the growth continues, 39% 2025 Q3, slower than the previous year's growth for the period due to the slower M&A transaction. We still recorded one in Q4 last year, but it was smaller. And in terms of EBITDA, very slightly modestly positive for Q3. However, if we adjust this for about 260,000 of integration and restructuring costs, we would have a Q3 EBITDA margin of about 3%. And we expect the improvement of margins to continue in Q4 and in the beginning of next year. Year-to-date revenue, 28.67 million for the 9 months of 2024, 2.5 times growth compared to the same period in 2024. All the other P&L categories are, of course, growing. The unproportionate one is the financial expenses due to depreciation of some receivables in US dollars. In terms of revenue breakdown, again, no major changes here compared to our last presentation. TMT remains the largest revenue, the largest industry in terms of source of revenue by more than 60%. We have also financial services with 16%, emerging verticals 12%, and automotive, aerospace, and defense 11%. Again, we report a growth in the revenue from the Middle East this quarter. year to date is 27% of total revenues from this region. North America is still strong with 29%, and the rest of Europe combined, including Bulgaria, is with 42%. In terms of currency, euro, we receive payments in euro, and they're about 46% of our revenue, soon to be more than 60 when we join the Eurozone after January 1st. US dollars, a third of our revenues are denominated in US dollars, and we have about 5% in Serbian dinars. In terms of balance sheet development, receivables continue to grow, to increase due to the growth of revenues and higher exposure to enterprise clients, which pay on longer terms compared to the smaller clients. We also have a significant increase in debt, which is due to the bridge financing, which we secured to complete the Prime Holding deal. The deal was completed in October, and the debt was paid off after the successful capital increase, which closed the transaction with Prime Holding. These are the results in a nutshell. In terms of upcoming corporate events, we plan to publish Q4 results at the end of February and to have our next earnings call in the beginning of March.
Thank you, Klimo, Costa, for the detailed overview. We will now move on to our Q&A session. Waiting for your questions. Actually, we already have questions. Let me start. The first question is, do you foresee the need for additional capital raising in the near to medium term to execute your growth strategy?
We don't plan to do another capital raise in the near term. Actually, with respect to the 2026 M&A activity, we are aiming to finance it primarily through debt, so that there is less dilution for our shareholders. We're exploring both bank debt, essentially leverage buyout, as a potential issuance of bond, but we are not currently exploring further capital increases.
Thank you, Costa. The second question is how effectively is Wyzer positioned to compete with local and regional competitors in its key markets?
That's a very significant question, and one of the reasons for our industry focus and kind of the rethinking of our whole go-to-market approach was to be competitive and well-positioned to win those projects. One of the things that we see clients appreciate a lot is not only having the technological prowess, but also understanding their business and their domain really well and speaking their language and understanding their business context, which requires also industry expertise. And this is one of the differentiating factors for Wyzer. At the bigger scale, if we think at the bigger scale, we are essentially at a size where we are not so small to be irrelevant anymore, but we're not big either. It's a place where we could already win projects for big customers, where we are already sizable and reliable enough to work for them, but hopefully more flexible than the big companies. And this helps us a lot as well to win new business. And the last thing I would know that, especially kind of this year, second half of this year, one of the things that we see is that our own Wyzer AI Factory product helps us a lot to win new projects and be competitive at the stage of actually competing for the project, by ways of allowing us to very quickly deliver some proof of concept value to our clients. Even at the stage of a proposal, sometimes we do invest to engineering time and therefore capital to build full-blown demos. Sometimes working with client data, sometimes working with mock data, so that we are able to present clients with not only with a proposal on paper, but actually show them a real demo at the time of the proposal. And this helped us win a few big projects. We'll likely announce another one in which we've won the bid, but we still signing the contract. So sometime Q1, we should be announcing another one, which was also won through a similar approach.
Thank you, Costa. Next question, Vasil Drumjiev. You made 2 capital increases in 2024 and 2025. The share price is currently 4.5 level. What is your comment on why the price is 4.5, and what action would you take to change this?
It's hard to comment on kind of stock market dynamics. Part of it is probably because of the margins, and that's one of the reasons, not the key one, but one of the reasons why we're shifting focus heavily towards margin expansion. The other one is that there's, at the end of the day, pretty low liquidity at the Bulgarian Stock Exchange. Probably if you compare Wiser to, in terms of multiples, to kind of some of the global competitors, I think there's plenty of room for us to grow in terms of valuation, but we have to earn it and we have work to do.
Thank you. One more from Vasil. Why is Nedelchev selling for a year and a half? Doesn't he believe in the company anymore?
I don't think Nedelchev has sold any major packages. So he's still a significant shareholder in the company.
Thanks. Okay, we are waiting for more questions now.
So
Yes,
going back to the 2026 strategic focus from the one of the first slides, there were 2 things that I saw, and I'm not sure how to think about it. First, on the delivery centers on lower cost locations, are we talking about reshuffling between Bulgarian cities, between Bulgaria and Serbia, or entirely new countries, for example? What will that mean in terms of business here?
We're looking at entirely new countries with significantly lower cost levels. Interestingly enough, between Bulgaria and Serbia, even though there are differences in the net salaries, if you look at the total company cost, it's pretty similar for similar level of talent. We do want to continue to work in our core destinations. We do have a strategic objective to grow in Serbia specifically because we see super strong talent there. That said, we're also looking forward to, and we're working on this with a partner already, to open a completely new delivery center in Asia.
Okay, so yeah, by far the cheapest will be India or maybe Pakistan. So you are willing to go in that direction, from what I hear.
Yes, specifically we're exploring Chennai in India.
Okay, all right, understood. And second thing, on low margin projects, can you disclose what is the share of revenue of these projects currently, and what is the margin discrepancy? And if you are about to drop them, legal-wise, how easily achievable is that?
So it depends where you put the threshold for the definition of low margin projects. And if you look at the whole portfolio of projects at Wiser, it's a pretty diverse, both across the industries as well as across some technologies, as well as in terms of margins. Obviously, it's very hard to win a customer, and it's absolutely not an easy decision to decide to drop a project. So we will do everything we can before that, including if we need to restructure the team to optimize the cost side, including trying to renegotiate the rates with the clients and all of that. But if none of that is working, we need to have the discipline to continue to push for margin expansion and therefore discontinue some of the projects. We'll of course do it in a way that will provide full support to our customers. So we'll not do it from today to tomorrow, and we'll give them heads up. We'll prepare transition plans. We might even help them pick another vendor. We'll help during the migration and do everything we need to do to make sure we are continue to be a reliable partner. Because brand is something that it's very easy to destroy. In terms of what percentage they represent, again, depends on the threshold, but I would say still about 20% of the engineering effort goes to projects with low project contribution margins.
All right. Thanks. And just one more thing to clarify on the India exploration or due diligence, or call it whatever. Are you talking about M&A there, or are you doing this as a green project on your own? If you decide to go with it.
Yes. So for India, we're doing this with a partner under what's known in the industry as build, operate, transfer model. So essentially, they are building the local unit for us. They're doing the candidate sourcing. We're obviously participating in interviews and everything. And then the team is working essentially for Wiser exclusively. The whole operation is branded under the names of both companies, and it's actually a large, very large player that we are partnering with for this model. Plan is to start with a relatively small team and kind of build the operational experience of how to fully integrate the team. Although we already have colleagues from all over the world, including we do have a couple of colleagues from India already, but kind of learn to do it in a more systematic way and then expand from there.
Okay, and probably the last question. Oh, sorry.
Just one comment on your previous question regarding the low margin projects. Starting Q3, we actually dropped one significant in size project, which was low margin. Significant in size means close to 2 million a year. And despite this, we managed to grow. So we actually, organic growth was really strong in Q3, and we managed to not only compensate for the fact that this project was dropped, but also to generate growth on top of that.
Understood. Probably the last question or group of questions from my end. That would be still on the revenue side in terms of growth. Can you provide more color in terms of verticals and regions, and maybe give us some update on the new office in Abu Dhabi? That should we think of it as probably the fastest growing region for you, and your strategic focus shifting to this region, and now with the new location in India, seems like you're concentrating your efforts in that space.
Yes, we continue to see fast growth in the Middle East. There is a little bit of a margin pressure there because of the currency, because everybody there is dealing in US dollars and our costs are in euro. But in terms of revenue growth, this is the fastest growing region. In terms of industries, there is not all of them are kind of growing pretty evenly in a way. So yeah, one thing to highlight was probably the Middle East.
All right. Okay, sorry. Last one. Since we mentioned margins and headwinds, during the presentation, I believe Klimen mentioned impact on EBITDA margin. And on the slide, it said 4% impact on EBITDA. I just want to clarify, are we talking about 4% hit on EBITDA in terms of currency, or are we talking about percentage points on the margin? And just want to clarify that.
That's percentage points on the margin, because about a third of our revenue is in US dollars, and there was about 15% depreciation of the US dollar.
Yeah, probably, but yeah, want to clarify that. It says otherwise on the slide. Just wanted to check this out. Okay.
Yes,
thanks.
probably not clear enough here, but what we mean is actual impact on the EBITDA margin by 4% points.
Understood. Well, thanks very much.
This was actually a big drag for. We're not using this as an excuse, and we need to do other things to compensate, of course. But this was a big drag for us this year. I mean,
I can imagine. We've talked about it in previous calls. Do you plan on hedging now that you've been hit so hard this year, do you have any plans for next year? How are you approaching currency risk? And it was also on the slides there as a headwind.
So beginning of the year, we wanted to do hedging, but because of the fragmentation between 10 different companies, including the fragmentation of the cash flow, the revenues, and all of that, and the complexity to manage all this, we didn't do it, which obviously had a huge impact. Now the conversation internally is pretty interesting because we don't want to lose in the other direction as well if we hedge right now. So current thinking is that we'll hedge probably half of the expected revenue for the next 12 months, so that at least half is kind of predictable, and the other half we will leave to market forces. We still have a few more steps in terms of restructuring before we do that, but we already kind of picked a partner to do it with, and we're working on the details. So bottom line is we'll hedge half of the expected revenue in US dollars.
Got it. Thanks very much.
Next one, Velizar.
Thank you for taking my questions. Two from my side, maybe the first for Climent and the second for Costa. The first one is again on EBITDA margin. I remember that you had a target of 5% for second half. This was communicated on the last earnings call. And now it seems that we are on 0% reported and 3% adjusted margin for third quarter. Do you think 5% is still achievable for the second half of the year? And if this is 5% reported or 5% adjusted margin?
It is achievable. Yes, you're right that we expected a little bit higher margins when we had our previous earnings call, but there were things related to our integration and growth and building of Wiser brand, which we had to simply do it, and this affected the actual result. With that said, I think 5% for the second half of the year is achievable with some adjustments, though. With next year, there are more significant measures that we're going to take in terms of improving profitability. So the trend of improving it is expected to continue in the next quarters.
Okay, thanks. And the second one is more on the bigger development plan of Wiser for the future, and these three phases that were communicated before a year and a half. It looks like, at least for me, that there is some delay in the execution. Can you please remember me what was the main topics for the phase number 3, and how do you see it as a timeline?
So there is the first phase essentially took, call it an extra year. So original plan was to do the kind of the growth to 25 million in 2 years. It took us 3 years, but we got to 39, so significantly more. We saw the kind of the growth opportunity. We were actually planning to shift to efficiency phase earlier, but we saw the growth opportunity, follow the kind of the growth. So yes, it took one extra year. We actually did start mid this year with the efficiency measures. So probably we didn't lose the whole year, but kind of there is delay from the original plan for a much bigger result in terms of scale, in terms of, and it's not only about the revenues, it's also about the client diversification. It's about kind of having a much wider and less risky foundation to build upon. With respect to the third phase, so for the second phase, we do expect again the same period which we stated originally, which is about 2 years. And we definitely work to have a much faster impact, but to get to a stable, sustainable EBITDA combined with organic growth. This is probably a reasonable time frame, and we're still thinking in this time frame. With respect to the third phase, this is where Wiser will already be the place where It is growing strongly organically and is delivering good profitability, which will allow us to take the next strategic steps. And these are more aggressive M&A, including in this phase. We'll have the confidence to be much more aggressive with leverage. This means potentially dual listing on a foreign stock exchange. And as we've shared previously, Frankfurt is a very reasonable target for us, but we feel we need to kind of achieve at least some of the things that we need to achieve in phase 2 before we take this step. And it means having the brand to in phase 3 to actually indeed play as a global player, which would require also M&A outside of our region and all of that.
Thank you,
Okay.
Costa.
Okay. Thanks. Just for as a conclusion, we can say that we are a little slower, but the final point is now much higher than it was anticipated in 2023.
It's a fair summary. Yes.
Okay. Okay. Thanks.
Thank you, Velizar. A few more questions from our YouTube channel. At what stage is the cost reduction process and integration of the smaller companies in the parent company?
With respect to companies, so ITDO, GoToAdmins, and Databreed are fully legally integrated. In terms of organizational structure, it's one single organizational structure already across Wiser, so we do operate as one company. In terms of systems, these are still fragmented. So like we have 5 different instances of 3 different accounting systems, just as an example, which creates a lot of overhead and complexities. And kind of consolidated cross-reporting, project reporting, especially now that projects span across legal entities. This is creating a lot of overhead. This is one of the reasons why we are pushing very hard to implement an ERP system, so that we have central repository of all this information, central repository of our processes and data. And kind of this will really unlock the next, with respect to indirect costs, the next opportunity to optimize those and also to run projects more efficiently. More specifically, timeline is in January, we launch the ERP with the accounting and finance module across all of the companies. And in July, we are launching the project operations module, covering all of the projects in all of the companies. By that time, we'll also further decrease the number of companies.
Thanks, Costa. Next one, when do you expect to be cash flow positive?
The difference between, and this is probably good seen on this slide that Klimo showed us. The difference between EBITDA and net result is about 4% as of today. This is with the financial expenses and all of that. So, and there's not much difference between net result and cash flow. So essentially, this means the moment we're stable at 5% EBITDA, we are cash positive.
Thank you. One more. Can you share whether you are currently in talks with potential clients in Germany and UAE following the establishment of your next entities there?
Yes, we are. Specifically in the UAE, this also came as a request from some customers and potential customers that we operate through a local entity. So this was an easy decision for us to seeing the demand to do this kind of this operation there. We actually have a lot of people in the company who are spending a fair amount of time in Abu Dhabi already, and on a rotational basis. We're looking to have even more local presence there because this is important for those relationships. In Germany, there were already 2 occasions where we were not able to participate in bids with our Bulgarian entity, but we are with our German entity. So we are kind of seeing this first results. But as of today, most of the value from the customers, most of the revenue from those customers is still generated directly through our Bulgarian entities. So we have not transferred those agreements and don't plan to. This is more for new projects and new customers.
Thank you, Costa. Since there are no further questions, we will now conclude today's presentation. Thank you all once again for your time and interest in Wiser. Wishing you all the best.
Thank you, and talk to you soon.
Talk to
Thank
you soon.
you. Bye.
Bye. Have a great day.